If your homeowner's insurance bill went up this year and you just paid it, I want you to stop for a minute. Premiums are up 24% in 3 years. The average homeowner is now writing a check for $3,303 a year, and most people treat that bill like a fixed cost. It is not. I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. Here's what's happening. Insurance companies have been hit with a long list of pressures. Inflation on the cost of rebuilding a home, more frequent and more severe storms and wildfires, rising reinsurance costs, and a lot of buyers moving into riskier zip codes. All of that lands on your renewal notice. In some states, it's even worse. In Louisiana and Nebraska, the average policy now runs more than $6,000 a year. That's over $500 a month before you have made a single mortgage payment. So what can you actually do about it? Let me give you 7 levers. Number 1, fortify the home, storm shutters, a reinforced roof, wildfire resistance vents, moisture sensors that catch leaks early. These are not cheap, but a study from the National Institute of Building Sciences found that hardening a home against hurricane winds saves $6 for every dollar you invest. Ask your insurer which upgrades qualify for a discount before you spend $1. Number 2, raise your deductible. Most insurers recommend at least $500. Going from $500 to $1,000 can drop your premium by as much as 25%. The catch? You have to actually have that money sitting in savings because you pay it before the insurance kicks in. Strategy beats rate always. Liquidity matters more than the lowest premium. Think about our Roth IRA strategy when it comes to those deductibles. Number 3, stop filing small claims. This one feels counterintuitive. The advice from a major policy holder advocate is simple. Do not file a claim that is below your deductible and avoid small claims when you can pay them yourself. Every claim can push you into a higher risk category. Save your policy for the losses you cannot absorb. Number 4, do not pay for more than you need. Every year, look at your policy limits and the value of what you actually own. A fur coat you insured for $5,000 10 years ago may not need that floater anymore. And here's one most homeowners miss. You're insuring the replacement cost of the structure, not the value of the land. The land cannot burn. Do not include it in your coverage amount. Number 5, strategize about insurers. Bundling home and auto can knock 5 to 15% off your premium. Staying with the same insurer for 3 to 5 years can save another 5% and 10% for 6 years or more. But here's the trap. Loyalty alone is not a strategy. Shop your policy every year or two. A recent study from NerdWallet found that smart shoppers save more than $2,000 a year. That's real money. Number 6, improve your credit. In most states, insurers use a credit-based insurance score to set your premium. The same things that lift your mortgage score lift your insurance score. On-time payments, lower credit utilization, a clean profile. If you've not seen your real FICO score lately, go to rsrlinks.com/FICO. That's rsrlinks.com/FICO. Number 7, think about insurance when you buy. Proximity to a fire hydrant, a professional fire department instead of volunteer, newer electrical, heating, and plumbing systems, brick and wind zones, wood frame in earthquake zones. The Insurance Information Institute says choosing wisely can drop premiums 5 to 15% from the day you close. Now, I want to be clear. I am not an insurance agent. I do not sell insurance. What I do is sit down with families, look at the whole picture, and refer you to trusted insurance professionals when there is money to be saved or a gap to be closed. Here's the bottom line. Picture this: a homeowner with a $650,000 mortgage paying $3,303 a year on insurance. By raising the deductible, shopping the policy, and cleaning up the credit profile, that the homeowner trims about $1,500 off the annual premium and tightens the savings position to absorb the higher deductible. That is not magic. That is strategy. If you want the tool I share with my own clients to track credit, build a budget, and watch your assets go to rsrlinks.com/keysteps. That's rsrlinks.com/keysteps. And remember, strategy beats rate always. I am Ron Siegel, your certified liability advisor, helping families build wealth through strategic debt management. Thanks for listening to the Borrow Smart segment, brought to you by rsrwealthbuilder.com. rsrwealthbuilder.com.